大家好，欢迎来到 YouTube 大佬透镜，我们用一张 PPT 解读财经大咖的深度分析。今天是2025年10月16日，我们一起来看看大摩今天关于中美贸易冲突的一个特别会议。先看要点，中美关系现状。大摩表示，中美关系处于脆弱的缓和状态，预计中美可能在年底前达成有限协议，维持现有关税暂停，但执行风险高，可能伴随更多口头对抗或小规模升级，稀土出口管制升级，新增5种稀土元素，并明确禁止通过第三方国家绕道，重点管制军事或芯片相关用途，出口许可证审批更严格，被视为战术性升级，旨在为谈判增加筹码，提高美国及其盟友在技术限制上的成本，同时传递信号，警告并影响美国盟友的决策。全球稀土供应现状。中国稀土开采、提炼和磁体生产方面具有技术和成本优势，全球稀土供应高度依赖中国。自2023年起，中国禁止稀土相关技术和设备出口，进一步限制海外供应链的发展。美国和澳大利亚正投资建设本土稀土加工能力，但规模有限，短期内难以取代中国供应。长期趋势，中美难以达成长期大妥协，因双方在技术限制和国家安全问题上分歧较大。全球贸易政策趋向限制性，碎片化和多极化加速。最重要的部分来了，以前我们多次提过，中文会议中有些话他们是不太敢说的。潜在投资风险，香港恒生指数自危机升级以来仅下跌不到 1%， 显示市场未充分计价不确定性风险。若双方公布更多报复措施细节，如美国100%关税、软件限制，或中国拒绝稀土出口许可，市场可能出现10%到15%的估值回调，这是基于历史经验的判断。大佬透镜用一句话总结，跌少了可能还要补跌。所以有投资港股的可能需要特别关注，深度研究一下，或者要不要干脆先出来观望一下呢？当然都需要谨慎操作。好，要点我们就分享这么多，接下来是大摩的完整版。这里是 YouTube 大佬透镜，我们致力于过滤垃圾信息，挖掘优质内容，欢迎订阅、转发、常来，坚持用多元化甚至互相冲突的信息给自己洗脑，所谓兼听则明。
Good morning and good afternoon, everyone. It is October 16, Thursday. Welcome to Morgan Stanley Asia Macro Webcast. My name is Crystal G, Asian EM Active Strategist. Before we start, please note that this event is for Morgan Stanley institutional clients and financial advisors only. It is not for member to press. If you are a member to press, please log off and reach out separately. Please also note that this webcast and questions may be recorded. Today we have Ariana Salvatore, U.S. Public Policy Strategist, Derek Kam, Asia Economist, Robin Xing, Chief China Economist, Jonathan Garner, Chief Asia Emerging Market Equity Strategist, Laura Wang, Chief China Equity Strategist, Rachel Zhang, Head of China Materials Research. During this webcast, you can send us questions at any time from the Ask a Question text box. Recently, there has been a lot of back and forth lately between the US and China, with the export controls on rare earths and the additional tariff threats by US. Today, we are very happy to have Rihanna on again. And can you share how you will play out? And then are we moving away from the TACO framework? And also, how do you view the long-term end game to look like? Over to you, Ariana.
Great. Thank you. And thanks for having me on again. Look, I think the important thing is to start with some context. So prior to last week, the US and China were in what we were calling, a very delicate sort of détente. The headline tariff rate the US had on China was around 40%. And anything on top of that, so remember that's the reciprocal tariffs, that went up to embargo level 145%. Those were on pause, and that was scheduled to exist until around November 10th. So it's been our thinking that the US and China probably will end up in some sort of narrow deal or arrangement in which that additional tariff, the reciprocal tariff, stays on pause around the end of the year. But importantly, we think that comes with a lot of execution risk. And we've been highlighting the potential for more rhetorical tit for tat or escalation ahead of what we consider to be a more durable kind of end state and this potential meeting between Trump and Xi at the end of this month. So the reason why this matters now is because we have to think about where rare earths sit in that dynamic. We think there's a pretty solid equilibrium, which is that the U.S. develops chips and sells some of them to China. China supplies the rare earths for the U.S. to build those chips. And so in that sense, it's not really in either side's incentive to disrupt that equilibrium meaningfully. But that doesn't mean that we can't see more tense rhetoric or escalation into certain events like the APEC summit. Another important thing to remember is that China's leverage is kind of waning over time. So as the U.S. is able to source or build rare earth capacity elsewhere, its competitive advantage will likely continue to grow. So we think that creates an asymmetry, which explains why we're seeing the escalation now and why we expected more, at least rhetorical escalation, before another potential narrow deal is reached. So to your question of, what happens from here, obviously, given the uncertainty, there's a wide range of outcomes. We laid out a bunch of scenarios. Our base case is that both the U.S. and China prefer the existing equilibrium over an abrupt supply chain decoupling. So both sides have an incentive to keep that escalation within a certain limit or boundary. We think you could see China implement some of the restrictions proposed, maybe the U.S. selectively implement some of the tariff. But we think something like the approval of the B30 chip being sold to China or something like that could grease the wheels for this kind of détente to return. And like I said, we made different scenarios, two more on the downside, one in which the measures actually go on, but only temporarily, and then a second case in which they are in fact more durable. And that's really where you would see that kind of taco idea fall apart, both of those two scenarios. The more constructive sort of fourth scenario would be one in which escalation actually gets so extreme that it catalyzes a resolution quickly. So you could see a deal come together, something akin to a higher level framework agreement like we've seen with other countries, more so than the restrictions that are currently in place. But again, you have to get through a little bit of the rhetorical downside to get to that more constructive scenario. That's kind of how we're seeing things from the policy side. Obviously, a lot of uncertainty, but that's kind of our view at the moment.
Thank you, Ariana. Just one question for now as a follow-up. How do you see this imply for the trade deals between U.S. and other countries, for example, Europe and other countries as well?
Yeah, so two really important dynamics. I think on the first point, this rare earths controls actually does impact the rest of the world as well. So Europe is going to have to reevaluate its relationships, its dependencies, and maybe you could start to see this kind of get folded into some other bilateral talks, right? So building these alliances elsewhere. We saw Japan and the U.S. sign a critical minerals deal a few years ago. So I think you're going to continue to see the fragmentation. That's just accelerating the trend toward multipolarity that we've been flagging for some years. And then I think the other thing that I would mention is obviously that we have a Supreme Court case ongoing as it pertains to the IEEPA tariffs. So that's a really important uncertainty. We're probably going to get more information on that in the coming months as the arguments start early November. And I think at that point, we're going to have more of a clear kind of outlook as to how much authority the president has when it comes to IEEPA tariffs. That being said, we think there's other authorities that he can use to kind of put those back in place. So I think you lose some of the immediate leverage because he won't be able to have that 10% baseline in place, but he can easily replace that with other tariffs. So the overall kind of trajectory of trade policy is still towards more restrictive, more trade barriers, kind of less free trade across the globe.
That's super helpful. I don't see any other questions on the line, and thank you so much for dialing super late from the US. Thank you, Ariana.
Thank you.
Thanks. And then next we'll move on to Rachel, and then can you provide some detail of the export controls and then what end products will be the most impacted?
Okay, thanks, Rachel. So from the policy side, if we compare to the previous one, what's different is one is they added the additional 5 elements. So there's 17 elements of the rare earths, and previously there were 7 type of elements that was under export control, and now they added additional 5. 2 is they have stated more clearly about against rerouting. So a lot of rare earths that was meant to use for military use or chip use, which were controlled on the export side, how the other country get access to those rare earths was through rerouting, through a different country or through traders. So those are now clearly stated as they do not want to be continued to see the rerouting. If it's containing the more than 0.1% of this that's contained originally coming from China, that will be under control. And also chip was not clearly stated before, so this is not clearly stated. The rest of the policy is relatively more of following the previous guidance. So the export control or banning export of the technology and also the equipment for rare earths, those were already in place since 2023. So those are not new. So from what we're seeing right now is a lot of this tighter control were somewhat in place already in actual enforcement, because China really never allowed for export of military use, but it was not stated publicly or officially. So some of this were just made it more official. There were also follow-up Reuters news talking about so one is this is export control. It's not export ban in terms of additional more type of rare earths included on export controls. It's not really banning. Reuters follow-up talked about there's become more strict and more difficult to get export licenses, a bit of similar to when we were back in April-May period. We did do channel check with industry contacts, which is true. It become more difficult to get approval nowadays, purely because of they try to tighten up on the revolting. So if it's continued as you're selling to a big automakers or other clearly non-military use, you can still export. The export control will still be able to get. But if it's blurry, it could be not non-military use or military use. Those will get a more tighter control. And it's probably just now we're seeing more market share now getting gained by the large magnet producers such as GL Mag, etc., that they are still able to get export licenses versus smaller ones probably not able to get export licenses. So this will getting tighter. In terms of rare earths, so there are multiple projects overseas right now, both from the mining side, from the conversion side, and also from the magnet side. Are building up outside China right now. Difficulty is more likely to be in the conversion and the magnet. The mining is actually relatively easy part. Rare earth is not really rare, so it is actually abundant globally. The heavy rare earths, so there are light rare earths and heavy rare earths. The heavy rare earths are relatively more rare, so that part is difficult to find. So currently, most of the deposits are in China and in Southeast Asia. The conversion side is more difficult to separate out the different types of rare earths. You have to add a lot of chemical into the process. So as a result, it's very, very pollutional. The last one, the magnet side, this part is a lot of know-how, and it is actually quite difficult to do. If we look at it globally, all the projects that's going on right now, MP has 10,000 ton. Everyone else have about 1,000 ton of the new production capacity that they're building right now. The average line in China is 20,000 ton. So just through the scale difference, you're going to have very different costs, let alone the know-how, because China is now no longer exporting the technology or equipment. So I think those will start to separate out, at least from a cost front, and also the size of those production outside China is still very, very small. May not be enough. So they probably still need to rely on import from China. I'll stop here.
Thank you so much, Rachel. Just a very quick follow-up. Do we have the stockpile number for different country? And then there's a client asking about whether U.S. is actually prepared to face the rare earth problems, and then have they already held up the inventory for several years?
There is really no official data on the stockpiling by each country. So that's just not available. For rumors, yes, there's a lot of rumors about how much U.S. already built, but it is nothing is official. So from preparation side, I think from MP, that's the U.S. company, and also Linus is Australia company. Both are now start doing their downstream and try to do their own magnet separation, etc. MP used to send the material to China to process. Now they're leaving it in US and they're building their own downstream to process. Also with the US government investment, MP's project originally designed for 1,000 tons as well. Now it's going to be 10,000 tons. So this part that they are now trying to be more self-sufficient and build it within US. But is that enough? Probably not.
Right. Thank you so much, Rachel. And then you can log off from here because it's very late there. So next we have Robin as well online to share more color on export controls and why they're further tightening and why they choose it to do it now. Over to you, Robin.
Thank you, Crystal. So as my colleagues, Ariana and Rachel mentioned, Beijing renewed its rare earth curbs ahead of the potential APEC meetings. The top questions we got from investors is this strategic or just tactical? I think it's both. It's a combination of a tactical escalation with potential off-ramp. That's still our base case. But meanwhile, it's also part of China's journey to institutionalize its own export control and the long-arm toolkit. So in my meetings in Beijing, I think a lot of local advisors and the investors, they don't see this as a new classic tariff war. They think it's more like a semiconductor counteroffensive. In near term, Beijing believes Washington broke that pause on non-tariff escalation since August or September by adding more Chinese firms to the entity list, by introducing tougher dual-use penetration rules, and also not mentioning the Section 301 actions targeting the Chinese shipmaking and the logistics sector. That's why on October 9th, as Rachel mentioned, they introduced these tightened rules for licensing for rare earths. This operation-wise is still difficult. If you think the U.S. export control and the long-arm toolkit, it has been there for decades, and it's quite mature with all this end-user verification, track and trace, licensing. For China, it's new. They only introduced these things May this year, and now they are tightening it. So it's a learning curve. And sometimes if they have overdone it, they probably will provide more flexibility on exemptions. But that's the direction China wants to have its own export control and this long-arm toolkit. And that's also reflected by the 4 rounds of talks between US and China. I think the bid-ask gap between US and China seems to be very wide, covering not just the tariffs, but also tech restrictions, national security, and geopolitics. So it's quite difficult for them to reach a durable grand bargaining deal. Instead, we do have the hope after the 2 leaders meet in APEC, there could be some off-ramp after this round of tactical escalation. But it might be quite fragile truth, given how much the 2 sides differed on things on the tech restriction and the national security. Now, that's about Beijing's calculus. Why now? We know there are a couple of rules from the US side, BIS. They will probably review some of these temporary licensing, and the TGLs will also be reviewed. Some of them is end of November, right? So Beijing is trying to create more chips ahead of these dates by introducing tightened rules of rare earths. This is also part of China's efforts for tech and the geopolitical export control. They try to copy a page from the US. However, as we mentioned, operation-wise, we look at the end-user verification, the track and trace. China is not at the same institutional depth or compliance architecture like the US had. But China is learning, trying to build its own small yard, high fence regime. If they have been overdoing it, they will probably provide some flexibility, some exemptions, but that's the direction. Now, it's also about sending a message to U.S. allies to reshape their calculus when they are joining the U.S. allied campaign or tax restrictions on China. For example, if the U.S. allies, be it European or Asian allies, if they are banning China from getting the access to equipment or software or development toolkit related to semiconductor, simply because that equipment or software has certain amount of IP content from U.S., China is basically doing the same thing now, asking U.S. allies to think twice before joining this type of allied restriction. Now, Rachel mentioned the status of China's rare earth dominance. Looks like they still have the time window to play this card in the next few years. Of course, there is always a risk of overreaching. If they have done too much, maybe there will be more joint effort to build some alternative supply chain. But again, it takes time, given the know-how, the crafting is quite unique, and China seems to be very able to produce at a massive amount, cheaper price and good quality for this rare earth sector. Last but not least, there have been some clients, investors asking, based on the commentary from the U.S. side, looks like the U.S. believe maybe this is not China's strategic top-down approach. Maybe this is more from junior execution level officials from China. Maybe it might be an overreaching mistake. We don't think so. If you read what China said and did in the last 4 rounds of U.S.-China talks, it's quite clear they are willing to institutionalize some of their export control muscles in exchange for relaxation on tax controls. For example, they probably want to slow or put a cap on the new add-ons to the entity list by the US BIS. And they said it publicly, and from the promotion of their own officials to the chief negotiator and all these things they talked after each round of US-China talks, it seems to be quite structured and consistent. So we think it's unlikely to be any junior level officials sending this rare earth control message without the top-down, the top-level endorsement. That's very unlikely. And by, if you accept that, that means it's very difficult for the US and China to have a durable, sustainable truce, because what China is asking in return for its relaxation of rare earth controls is try to slow or put a cap on tax restrictions, no more new add-on to the entity list, and also try to stop these shipbuilding 301 sanction rules against the Chinese logistics. All of these are probably also politically difficult for the US side. So that's why I think the bid-ask gap between the two sides are quite wide, and any truth after this tactical escalation could be there, but could be very fragile. With that, I will stop here and hand back to Crystal.
Thank you very much, Robin. We have Laura on the line as well. Laura, can you share your views on how it will impact the China market and what are people currently pricing in?
Yeah, frankly speaking, I don't think the market is pricing much of the uncertainty that's been rising significantly since Friday. If you look at how the Hong Kong market has been behaving since Friday close, before the crisis mode officially kicked off, today, as we are talking at the moment, Hang Seng Index is less than 1% down versus last week's Friday close. So apparently, I think investors are still trying to approach this, believing that there's going to be a approaching back to the table kind of scenario between the two countries, which we do not necessarily disagree with. But as my colleagues have pointed out earlier, the uncertainty has risen significantly versus the previous rounds, and the possibility of the two countries potentially reaching a very sustained equilibrium, like for multi-year period in a very grand bargain or grand deal format, I think that probability has come down, and the investors may not be prepared for such a scenario or outcome. The way we look at this is that, there have always been signals and signposts leading up to the outcome of the trade negotiation. It never really happens sort of very abruptly. So there would be things that we monitor very, very closely in the next few days, in the next couple of weeks or so, before the critical date, November 1st, which is when the president meetings between the two presidents were scheduled to happen originally. But before that, or within those period, if we're starting to see escalation signs, and particularly if the market is sort of responding to that in a very slow fashion and not particularly pricing in a bigger or higher equity risk premium, either for the China market or for the US market, but more specifically for the China market, then we think the correction is likely to widen in a quite significant way. So basically, the signpost we're watching very closely is that if the two sides are starting to give more official details about the implementations of their retaliation measures against each other, that means things are getting more serious. For example, from the US side, of course, by now we know there's going to be a 100% additional tariff being imposed against Chinese goods. But aside from that, critical software restrictions have also been mentioned. So exactly what that entails, what's the exact scope of that? I think naturally people think of EAD, but is it just new purchases or current maintenance and upgrades, or like a sort of a hard stop of usage of all the existing purchases, or there's going to be even a broadening out of the scope of softwares, for example, CAD or ERP, etc., etc. So as more details come out, hopefully they don't, but if more details are being released, then we think things are moving in a more sort of negative direction. And then, of course, from China's side, what had happened on Sunday was sort of a relief as the Ministry of Commerce started to give more details about the rare earth export control, to make it clear that it's less about banning or sort of severe restriction, but it's more about institutionalizing and making things more systematic. But if we start to hear more sort of, suspension or kind of rejection of recent applications, that means things are potentially also escalating in the direction that we don't want to see. And also any reference of cancellation of the president meeting, that would be a negative sign. And of course, I think some familiar references to ADR delisting or more additions to the entities of Chinese companies by the US government, those would be signs that tell us that things are not going well. And if we look at previous sort of incidents of very significant escalation of tension between US and China, in the maximum case, MSCI China, if we focus on that market index particularly, we've seen up to around 13 to 15%-ish of valuation derating. And usually market tends to react more on the valuation derating side, given how rapid the development could evolve. So we would say, at least we want to see another 10 to 15% of correction in the China market before we can start to look at that potentially as a buy the dip opportunity. And as I said earlier, the market is less than 1% down versus Friday close. So apparently nothing much is being priced in at the moment. So we think focus on quality should still be the right way to go. Basically, earnings resilience, past track record of earnings delivery, and then a resilient ROE trend. Those should be the things that we focus on. We also recommend investors to still keep certain exposure to dividend yield plays. We've always been saying that as we go into the fourth quarter of this year, things are likely to become more volatile in the China market for a couple of reasons. Number one, the market has gone up so much, being the best performing market year to date. So there is naturally some profit-taking actions potentially. And number two, we are expecting a slowdown on the macro front in the second half and particularly into the fourth quarter. And we're seeing some macro data prints to show that trend already. So I think, a focus back on earnings, on quality, as well as certain exposure to stable cash income should help us navigate the near-term volatility. But on the longer-term basis, I think high-quality names on the tech front could still benefit, because I think this recent incident just reminds us self-sufficiency will be a key theme for China going forward, but not just for China, potentially for many countries going forward. But in China specifically, technology self-sufficiency and then better supply-demand dynamics in terms of anti-involution actions going forward, those will remain the long-term thematic opportunities. And we have stocks readily available for those who are looking at a much longer-term time horizon. So with that, I'm going to hand that back to Crystal. Thank you.
Thank you so much, Laura. In terms of the regional context, can I invite Jonathan here to talk about broadly in Asia EM, how should we position? And then what's your feedback from your US marketing trip last week?
Yes, thanks very much. And what I'm going to say is consistent with everything you've heard so far on this call. But before I do speak, though, I would just like to remind investors on the call that the Japan Institutional Investor, now called XDEL, survey is ongoing. And if you are able to support us and the wider Morgan Stanley team in the strategy area in that survey, we'd really appreciate your support. In terms of what you just asked me, I mean, it's very consistent with what you just heard. I think investors are underappreciating the risks here. It's paid at times to have this view that kind of de-escalation will always pan out ultimately. But as Robin went through at some length, China's making careful strategic choices here. This is not just a tactical exercise ahead of the APEC summit. And I think it has come as somewhat of a shock to the US side. And so the point we made in our note at the beginning of October about valuation re-rating not likely being sustainable, I think that's absolutely where we are now. So again, consistent with what Laura just said, we are trading between 1 and 1.5 standard deviations above 10-year averages for vanilla forward P across the region, with approximately double-digit downside to base case targets. And so risk-reward is quite unfavorably skewed here. In my travels in the US last week, I would say that amongst more seasoned investors, there's a quite high degree of apprehension, both on the topics of trade tariff impact on the economies of the world, but also on topics like AI capex and just more general sort of disquiet on issues like fiscal sustainability, the way that gold is so dominant in its performance this year amongst asset classes. So I think amongst that kind of investor, moving to the sidelines is ongoing at the moment. But I guess amongst less seasoned investors, and those with shorter time horizons, I think there's this tendency to sort of be involved, this highly thematic approach, not really thinking in a more holistic macro framework, as we try to do on this webcast, and in particular not thinking about valuations. And I think on those grounds, I would be pretty cautious here. And we've tried to make that view plain in both the investor presentation and the note from earlier this month. So do check that out. Thank you, Crystal.
Thank you, Jonathan. And last but not least, we have Derek, our economist, here as well. So in terms of the Asia context, can you talk about the implications on Asian economies and which countries will be more exposed to the export controls?
Sure, Crystal. I think a lot of my colleagues have actually laid out the case that, why we sort of see this as a tactical escalation, but we also don't see a durable sort of grand bargain kind of situation. And so what this really means is that trade tensions is still with us in the background. And the implication of that will be that, uncertainty remains. And as we've sort of been highlighting consistently in our research, that uncertainty is the enemy of the business cycle. And so the main channel that this will actually impact is through sort of like the business sentiment and therefore through the capex cycle. Now, obviously, the risk that we are watching for is if the tensions prove to be more durable. For instance, my colleagues have also laid out the differences between the bid-ask on what the US wants and what China wants. And so there is actually sort of questions as to how quickly we can get to the resolution or back to negotiations. And if we don't, then that just means that we could sort of face a sort of more prolonged period of escalation than we were expecting. The second risk that we are really watching for is potential supply chain disruptions. Now, as with these export controls, the rest of the world now needs to sort of negotiate with China to get exemptions from China. And so as they're sort of negotiating with China, there could be sort of potential issues that can come up where tactical escalations in other bilateral relationships could come up, resulting even in supply chain disruptions, especially for those like in the defense segments that Rachel was mentioning about. So we're watching quite a number of risks over here. And I think that sort of sets up the backdrop of what's actually happening to the exports data at this point in time. What we are seeing is an increasingly divergent story within the Asia exports. For example, the headline exports have actually been doing okay through September. There's been a boost from sort of more working days in both Korea and China. But the underlying dynamics are suggesting a very, very critical split. Tech exports right now are surging at about 17% on a year-over-year basis, driven by, unsurprisingly, AI demand and a memory recovery. But the non-tech exports of the equation has actually slowed to just about 2.3%, which is a 6-month low. And we think that this divergent outlook will matter over the coming months because non-tech exports actually accounts for about 3/4 of overall Asia's exports. There are a number of things to sort of also highlight, some of these which have actually come through in the questions that have been posed already. For instance, number one, exports to the US have actually weakened quite sharply because the front-loading effects are reversing, while the exports to the rest of the world, particularly for Europe and within the region, have been sort of relatively strong. Second, it's also that because of the dollar weakness, we do think that the headline exports number that is denominated in US dollar terms may actually be sort of overstating the export strength because local currency exports are actually a bit weaker at this point in time. And the third message that we have been taking from the recent trade data is that, as I was highlighting right at the start of the conversation, we are watching very clearly the capital expenditure momentum, and the capital goods imports in Asia have actually been decelerating since Asia, and it's on a fairly broad base, which is suggesting to us that the trade tensions are weighing on corporate confidence, just as we were expecting. So bottom line from us, watch out for the risk of trade tensions. And while the tech is providing the near-term support to exports, we are expecting non-tech exports to weaken and also therefore overall exports growth to soften from here. That's it from my side. Crystal, back to you.
That's super clear. Thank you, Derek. Now we are moving on to the Q&A session. There are several questions for Robin, so I will just ask them together because of the time constraint. So firstly, the question is, what kind of leverage that China is trying to achieve? Is it mainly on the tax restriction by the other countries? And then the second is on rare earths. Is it really possible to implement that and then track the source and stop the rerouting? And have we seen a drop in the total rare earths export already? And then the last question is, how do we expect the two leaders meeting on November 1st? And then it's going to be a temporary deal or is it going to be a sustainable one?
Thank you, Crystal. First of all, I think the leverage China is looking for is definitely aimed at tech restrictions, not tariffs. So Beijing's ask is probably about execution level relaxation on tech. For example, slow or cap new entity list add-ons, and also extending these TGLs by the BIS. These general licenses to protect the Chinese manufacturing input and AI chips. But strategically, Beijing's goal is to raise the cost of sustaining the US small yard, high fence strategy. They are raising the cost for the US and its allies to influence the US allies' calculus. That's number one, the first question. Second one, on rare earths, can China really implement? Well, we kept saying they are new in the game, right? Copying a page about export control, long arm toolkit is not easy. So implementation, I see partial implementation in your term. China can tighten at the source, like miners, refiners, magnets makers, but that's more like a control the overall supply instead of doing very targeted end use verification, track and trace. Is all very difficult. So China's compliance and the institutional level of depth, they still need time to get there. But I think they can control overall supply. That's already creating some tightening for the US. The data so far showed that in May and June, when China found the US is tightening on some non-tariff barriers like tag, they will definitely try to respond with controlling exports on rare earths. Back then, rare earths export volume declined a lot. Last but not least, how do we expect from the meetings November 1st, or if there is a meeting? Base case is tactical de-escalation. So the two sides, we may provide some off-ramps, provide some guardrails, and to temporarily stop escalation. But it's not a sustainable grand bargaining deal. For example, they may try to provide a predictable supply for rare earths in near term, that kind of commitment. But in return, China is probably asking a pause on the new entity list add-ons or clarifying this BIS TGL license extensions. So that's probably the near-term guardrails or de-escalation. But it's very difficult for them to have a sustainable longer-term deal given the bid-ask gap about rare earth for tech. That's still very difficult. I will stop here.
Thank you, Robin. And then the next question is for Derek. So do you still see a lot of inventory left in the US broadly for all goods? And then whether we'll really see the economic impact from that 100% tariff. And there is another question on the impact on Asia broadly, and whether that will lead to the excessive dumping from China, and maybe that will lead to additional deflationary risk in EMs in Asia.
Yeah, thanks a lot, Crystal. I think about the first question, if you look at, let's say, the US data for both retail sales and inventory, it doesn't suggest that there has been actually a significant pickup in inventory levels overall relative to retail sales. But this is also taking place against a backdrop where retail sales have actually been doing pretty okay in the US so far. And so I think that sort of remains something that it is to be seen. As to sort of the question on whether the 100% will hurt trade, I think, we've heard from Robin before previously that, these levels of tariffs are going to be effectively going back to where we were sort of like in April. And so therefore that will probably lead to an embargo level kind of situation, which means that trade from both sides will definitely be disrupted and therefore leading to implications for both the economies. And then I think the other sort of situation on the dumping issues potentially, I think what we are seeing is that China has been able to export or maintain its exports growth. You can see that in the recent numbers where headline exports growth was sort of still around 8%. And a lot of that has been driven by exports to other parts of the world. We've done some work previously in the specific case of, let's say, for example, India, where if you look at the categories in which India has widened its trade deficit with China, it has also been correspondingly reflected in a sort of disinflationary or even deflationary pressures at the wholesale price level for those product categories. So I think that impact is definitely sort of coming through. And I think the other sort of region that one should be sort of a bit more concerned about is for us here in Southeast Asia, where, if you look at systematically speaking, imports from China have actually been higher as of, let's say, compared to December 2017, when the first round of trade tensions first emerged. And in recent months, the import share from China has actually moved even higher. And so that we think will continue to sort of exert disinflationary pressures most prominently in these two parts of the region. Crystal?
Thanks, Derek. The next question is quite separate from the export control topic. This one is on India, so I guess it's more for Derek and Jonathan together. How do you view the Indian market lagging behind the other markets in Asia, and what catalysts are people waiting for? Maybe both from the economic perspective and also from the market perspectives.
Yeah, India has underperformed this year after 4 years of very significant outperformance. So it's not managing 5 years in a row. The key outperformers, other than Hong Kong, China, are of course Korea and parts of the sort of Asia tech universe, I guess. I think India, with its strong domestic demand story structurally, probably come back into focus, particularly in a more bearish environment for global growth. Valuations have derated significantly, so it's well below its 10-year average valuation premium to the rest of the asset class. And I think what's particularly interesting right now is we just do seem to be getting news, whereas unlike the situation between US and China that we focused so much on this call, it does appear that President Trump has had discussions with Mr. Modi about the key source of dispute about India's purchases of Russian oil which may mean that they are heading down a more positive path in the geopolitical relations there. So I think that's a very brief summary on the equity side of things. But Derek, you should pick up on the macroeconomy. Thanks.
Yeah, definitely, Jonathan. I think a couple of things that sort of has been played out in India as well, which is that we've sort of been expecting a recovery, but the recovery has been delayed. I think firstly was sort of the issue around the pickup in public capex spending, which was sort of weak until only about, like, I would say maybe the last 6 months or so. And then I think subsequently there was actually a whole bunch of tightening, which was on the regulatory side, which was holding back credit growth. Now, we think that actually a recovery is going to be in place this time around for a few reasons. One is that although we had the first interest rate cut in India in February, it wasn't really until April where we started to see a meaningful fall in interbank rates when the central bank was able to inject durable liquidity into the system. And now, according to our banking analyst Sumit, he expects that the decline in policy rates or interbank rates will transmit to economic activity with about a 6 to 8 months lag, which kind of brings us to where we are right now. And then the other two factors has been that, we've had an income tax cut, which has been effective from May onwards, but also more recently, the rationalization of the GST structure, which we think will actually help to bolster consumer spending. And indeed, in the festive season that has just passed, we're seeing that consumer spending is actually picking up quite robustly. And on top of that, you have the most recent measures from the RBI on the regulatory easing side of things, which we think will actually help to boost bank credit growth and also, therefore, economic activity. So we are expecting a recovery to take place quite strongly from here, Crystal.
Great, that's super clear. Thank you so much, Jonathan and Derek. And in the interest of time, we'll conclude today's webcast here and answer the remaining questions offline. Thank you so much for joining us, and do reach out to me and the team if you have any other questions. Have a nice day and see you next week.